Number 4, in determining whether transactions have been recorded, the direction of the audit testing should be from what? So we want to see whether or not they've been recorded. We want to see whether or not the transaction has been complete. So we're going to start where? Well, let's come back over here. We talked about inspection, examination of records. We talked about tracing, vouching. Tracing is from the source into the books. That tells us it's been properly recorded, that it's complete. So we're looking for that. Versus vouching is in the books back to the source. That tells us the asset exists, transaction occurred. So, general ledger, that's the books going out. A trial balance, books going out. That's existence or occurrence. Original source into the books, yes, that's going to be completeness. General journal entries, no. So the best answer is C, because the other 3 deal with existence or occurrence. That deals more with vouching than tracing. Number 5. Which of the following comparisons would an auditor most likely make in evaluating an entity's costs and expenses? So costs and expenses show up on what? Income statement. The current year's accounts receivable with prior year's accounts receivable, that is not really for costs and expenses. Receivables, that's asset. Current year's payroll expense with prior year's payroll expense, would you expect there to be some consistency, income statement to income statement? Yes. Remember we said for analytical procedures, income statement is better than balance sheet because you expect there to be consistency. Could you compare this year's payroll expense with last year's? Yes. C, budgeted current year sales with prior year sales. Sales doesn't deal with cost and expense. D, budgeted current year's warranty expense with the current year's contingent liability. You'd probably want to compare budgeted warranty expense with actual warranty expense. Which would decent, better answer, B. Number 6, to be effective, analytical procedures in the overall review stage of the audit engagement should be performed by whom? We said as the overall review. Who did it? Who did it? Me. All right, the new hire. But who else? They said what? The partner or the manager. A, the staff accountant who performed this some sort of audit procedure. Well, that's probably the real answer in the real world, but not for the exam. B, the managing partner. That's the guy I said you only see at the Christmas party. The manager or partner who has a comprehensive knowledge of the client's business and industry. That sounds like a good general answer. D, the CPA firm's quality control manager or partner who has responsibility for the firm's peer review. That sounds more like PCAOB stuff. Best answer, C. An auditor most likely would analyze inventory turnover rates to obtain evidence concerning management's assertion about what? What is inventory turnover? It tells us here how often inventory turns over, cost of goods sold over average inventory. It tells us it turns over 6 times a year, or basically if we did way over here, every 60 days. That tells us what? How old the inventory is. Is the inventory saleable? If it is, great. If it isn't, what does it tell us? Does it exist? And let's try that. Does the inventory exist? Yes. Do we own it? Yes. Is it all properly classified? Yes. Is it all there? Yes. Is it valued correctly? No, because it's obsolete. Inventory adjustment. So what does it deal with? Valuation.